Hi everyone, I am Deric. Welcome to my channel. In this video, I'm going to talk about market anomalies. A market anomaly is a price action that contradicts the expected behavior of the stock market explained under efficient market hypothesis. In other words, anomalies challenge the assumptions of the efficient market hypothesis, suggesting that markets are not always perfectly efficient. They imply that there are opportunities for investors to identify and exploit mispricings or inefficiencies in the market. Studying market anomalies is crucial for several reasons. First, investment opportunities. Recognizing anomalies can help investors identify opportunities for generating alpha or excess returns by exploiting these inefficiencies. Second, risk management. Understanding anomalies can also help investors manage risk by avoiding assets that may be overvalued or prone to sudden price corrections. Third, academic research. Market anomalies are essential for academic research as they challenge and expand our understanding of financial markets and human behavior. The following are some examples of market anomalies. First, calendar effects. Calendar effects refer to the observed patterns in stock returns that are closely tied to specific times of the year or week. These patterns can deviate from what would be expected in a perfectly efficient market. For example, Monday effect. The Monday effect, also known as the weekend effect, is an anomaly where stock prices tend to decrease on Mondays compared to the closing prices of the previous Friday. Several factors can contribute to the Monday effect. One explanation is that over the weekend, investors may become more risk-averse after reading news and information, leading to lower demand for stocks on Monday. Additionally, there might be a delayed reaction to events and news that occurred over the weekend. Another example is January effect. The January effect is an observed phenomenon where stock prices tend to rise significantly in the month of January following a decline in previous December. There are various theories behind the January effect. One theory suggests that investors sell stocks in December for tax-related reasons, leading to a decline in prices. Then in January they reinvest, causing prices to rise. Another theory is that fund managers engage in window dressing by buying stocks with strong performance in January to improve their year-end performance reports. On the other hand, the September effect is a calendar anomaly where stock prices tend to decline in the month of September. The September effect has been linked to various factors, including investors returning from summer vacations and selling stocks, as well as the end of the fiscal year for some institutions, leading to portfolio rebalancing. Economic data releases and geopolitical events in September can also contribute to increased market volatility. Second, small firm effect. The small firm effect is a market anomaly that highlights how the size of a firm impacts stock returns. Research and historical data suggest that smaller firms, typically categorized as small-cap stocks, may offer higher stock returns than larger firms, such as large-cap stocks, even after adjusting for risk. This effect challenges the efficient market hypothesis, which would predict that all stocks should provide similar risk-adjusted returns, regardless of their size. Possible explanations for this anomaly include the fact that smaller firms may be less followed by analysts, making it more likely for them to be mispriced, and their agility to adapt quickly to market changes. Third, neglected firm effect, which is another anomaly that is similar to small firm effect. Neglected firm effect is an anomaly observed in financial markets where lesser-known companies tend to outperform better-known companies. This phenomenon contradicts the conventional wisdom that popular stocks should offer better returns. The neglected firm effect suggests that investors may overlook or undervalue lesser-known firms, creating opportunities for those who can identify and invest in them. Fourth, earnings announcement effect. Stock price adjustments may continue after earnings adjustments have been announced. In theory, if the stock markets were efficient, then company earnings announcements would cause an immediate shift in stock prices, as the report is instantly factored into the market price. However, in practice, it can take up to approximately 60 days for markets to adjust, with a positive earnings announcement causing stock price increase and a negative earnings announcement causing stock price decrease. Therefore, unusually good quarterly earnings reports may signal buying opportunity, as the stock price will continue to increase in the following 60 days. Fifth, PE effect. Low PE stocks may outperform high PE stocks, even after adjusting for risk. In essence, it challenges the notion that higher valuation stocks, high PE, are inherently better investments. One possible explanation is that low PE stocks are often considered value stocks, and investors may be drawn to them when they perceive them as undervalued or when they anticipate higher future growth. Sixth, reversals effect, also known as mean reversion effect. This is an anomaly observed in financial markets, where stocks that have performed exceptionally well or poorly over a certain period tend to reverse their performance in the subsequent period. In other words, yesterday's top-performing stocks are likely to become underperformers in the near future, while yesterday's underperformers may become tomorrow's top performers. This phenomenon challenges the idea of perpetual trends and highlights the concept of stock prices regressing to their mean or average values over time. Mean reversion suggests that extreme price movements are often followed by corrections, creating opportunities for investors who can identify and capitalize on these reversals. Seventh, dogs of the Dow effect. The dogs of the Dow is an investment strategy based on selecting stocks within the Dow Jones Industrial Average, DJIA, that have certain value attributes. Specifically, it involves choosing the 10 highest dividend-yielding stocks among the DJIA components at the beginning of the year. This strategy gained popularity because it appeared to offer investors the opportunity to beat the market by investing in relatively high-yielding and potentially undervalued blue-chip stocks. However, it is considered an example of the dangers of trading anomalies, because in practice, it may not consistently outperform the broader market. While it has had periods of success, it can also have periods of underperformance, and its simplicity may not always lead to superior returns.